Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic here is getting started with stock investing. And today we are going to discuss the when to buy concept here of this particular series. You know, the stock market has given us a bit of a bounce in the last couple of days. And I felt as though that bounce would afford us the opportunity to talk trend analysis a little bit more clearly, incorporating existing market scenarios, give us something to kind of cover the concept, but also look at the real world side of things where we reside in the way of the current trend and some thoughts for all of you to consider. Additionally, though, we're going to be looking at our example portfolio through the monitor tab here in the Thinkorswim desktop application, and likely going to be looking to deploy some new money. So we're going to talk for about 30 minutes or so about trends and trends existence in the current market scenario, and then migrate over to putting some of that money in my example portfolio to work as we continue to build out a longer term view on the marketplace here. So with all of that stated, let's say hi to my friend Scott Thompson in the chat today. We don't always get Scott with us in chat, but it's great to have him. He'll keep an eye on things for us and certainly get to and reply to comments and questions that I'm unable to get to. Of course, I'm going to keep an eye on things there. I do want to hear from you there, so please feel free to send those in for the duration of the show. We will go about 40 to 45 minutes. If you're not already doing so, both Scott and I are available there on the X side of things. You can follow me there at Kevin Horner CS. And I'm going to have Scott. I'm not positive that Scott's available on X, as it turns out. If he were, it might very well be at Scott Thompson CS, but may very well not be available, as I'm seeing here from the chat. But nonetheless, I would appreciate your follow there, everybody. Real helpful to me. Let's get into the disclosures, and then we'll start talking about trends and understanding trends, some things that we can conceive of as we learn about understanding trend analysis here. So the big takeaway, as always, is that our conversation is exclusively informational and educational. We do not make recommendations nor endorsements for a particular approach to trading, not a specific strategy of trading either. So keep that in mind. We will be talking some semblance of technical analysis here today. As we do that, technical analysis should be considered just a piece of your overall puzzle. But for many of you investors who think about things from more of a fundamental standpoint, an analytical standpoint, this could be the key component to helping you decide when it makes sense to, so to speak, put more money at work versus pull money from the market. So not to suggest that timing the market for investors is the right approach, but rather an understanding of when the market is trending favorably for bulls. That's a time when long-term investors might want to start to deploy that money versus becoming defensive. I will explore that with you all as we work through this understanding today. So more context as we move through. Now, I stated this is a series of classes. So while this is the agenda for us today, Scott has posted for us in the chat a link to the archive for this one. So if any of the other topics in this series discussing, the whole process of getting familiar with stock market here, including investing basics, what is a stock, for example, what type of detail should we be paying attention to in fundamentals, etc. All of that's going to be available in the archive link that Scott has shared. And this class is, of course, being archived and will reside there probably some point early tomorrow as well. For those of you who maybe want to review, or if you can't stick around, that's the place to bookmark and check us out when you have the opportunity. Now today, like I said, we're going to identify some key technical indicators. Essentially, though, that's just basics. That's support and resistance, and what is an uptrend, what is a downtrend, and then we're going to, like I said, look at what's happening in the existing market. And I finally see that I was right. Scott does have a Twitter handle. It is at Scott Thompson CS. So just as I suspected, he's available for us there. All right. So with that, let's talk about the basics of a trend. What makes an uptrend? Well, it starts with the series of higher high prices and higher low prices. And as you can see on the chart here, we have a few of those higher highs and higher lows. And I'll try and designate that for you here with my pen, see if I can't highlight a couple of these. So here's a higher high, followed by more highs, etc. So along the way, what we will commonly get, of course, are retreats. And those retreats are pullbacks, standard in nature, percentage-wise, pretty consistent, and essentially giving us a pretty obvious set of stairs, right? We've got an up stair, and we pull back a little. We've got a nice big up move. We pull back a little. So this is very common what a bullish trend looks like. And the easiest way to define that is when you're looking at the chart and the window of time you're considering, am I working from the lower left to the upper right? Or perhaps am I working from the upper left to the lower right? Certainly, if we're bulls and bullish in nature, we want to be buyers of equities. We are looking for trends that resemble the one we're showing on the screen here. Now, that moving average line, that is a dynamic line that is provided within your, in this case, the Thinkorswim desktop application. And what it's doing is smoothing out the price action for us. Simply taking, in this case, a 30-day look. It's looking at the last 30 closes at price, and it is adding them all together, dividing it by 30, and giving us a new dot along the chart range. So ultimately applying a new level each day we move, and it's called dynamic because we move with the price, obviously. So the speedier that moving average is, or the fewer number of days associated or periods associated with that moving average, we would say it's faster rather than slower. So 30-period moving average is looking at the last 30 trading days. We would estimate that to be about 6 weeks, 5 trading days in a standard week. So that's where we get 30. Now, I can't say that it is the most common of all moving averages, even though we're utilizing it here. And so, of course, we commonly hear, well, Kev, what are the most common moving averages then? Well, the answer to that is, commonly I would suggest 20, 50, and 200 days. These are the ones that I've most commonly heard about and most frequently hear from traders and investors alike. And the truth of the matter is, the moving average that matters is the one that seems to be respected by price. Now, let's just remind ourselves what price means. Yes, we understand what price is, right? It's the true value of the underlying stock, but it's also quite clearly a reflection of how traders and investors alike feel about the price of the security relative to right now, right? It is a reflection of all that is known about that stock at any given moment. Now, in addition to trends, we have basic details like support and resistance, and these are commonly areas where price changes and lets us understand where the sentiment of buyers and sellers may have changed as well. So support and resistance commonly is referred to from a horizontal standpoint, whereas trend analysis is more consistent with uptrending and downtrending, of course. And horizontal support and resistance will come into play commonly when we see these trends start to shift and break. Okay, so support and resistance, think of it as we state here as a floor ceiling approach. When you have price action running to the same level over and over and then reversing course as we seem to have here for a few periods, right? You've got this test here. There's another one here. We were above it for all of a day here. These are all considered tested at resistance and then moved lower. So we would state that the resistance level here is our ceiling. And when we bang our head on the ceiling, the expectation isn't that we're going to necessarily move through it, certainly not on the first effort, right? Because sometimes it takes a little while to break down that sheetrock that's above your head, right? Well, that's kind of what a resistance bar can be. It can be like a bit of sheetrock overhead. But once you break through that sheetrock, now you have the opportunity to move higher. You have taken out the resistance at the ceiling, and have now made your ceiling a potential floor. And you'll notice right here and right here, what occurs when that happens is what we call the throwback. The throwback is having busted through the ceiling of resistance and then said, all right, cool, we're happy with what we got there. Now let's go back and test that now floor for stability. Let's put our feet on that floor and see if it's going to hold us. And that's what we're looking for. That is considered a point of confirmation. Same thing here, right? Because we moved higher, and here we come back to that floor, and now we're standing on it, kind of running on it a little bit, and just making sure that it is totally stable for us. If we can get confirmation of its stability, then from the bull aspect, they start to feel confident and start to position. And of course, we're not going to show you an example that doesn't work in our favor, but this is exactly what we're looking for, right? A series of higher lows, higher highs along the way. That is a new trend that occurred after a breakout and a few tests to validate and verify that what was resistance at one point has now become support. Now, of course, the same is true, everybody, when we think about this on the exact opposite, right? If it's support and it breaks down, well, then it becomes a ceiling for us. So instead of all of this upward price action, if prices started moving lower like so, we would say here that we fell through what once was support, we fell through it, and now we've got our legs dangling beneath us as we're trying to hang on to the ceiling that's former ceiling, now the floor, right? So yes, this is so important an aspect, is the recognition that you've fallen through support. Now it's time to become defensive. Whereas, hey, you've broken through resistance, you've verified and validated former resistance, now support. Now is a time when you can start to feel more comfortable. It doesn't mean that you can, put all your money to work immediately, as many of you are stating here. It then becomes a conversation of risk management. How do we position ourselves? How do we build trades based on that, or decide to use these breakouts or breakdowns as reasons for taking action? All right. And then beyond the standard basic details here, as we've talked about, trending, uptrending, downtrending, higher highs, higher lows, lower highs, lower lows, etc. We have some basic oscillating details, something like a MACD, for example, and the oscillators can be used to give you signals of indications where things might be starting to shift. And something like the MACD could be helpful to the trader when things start to become a little less exuberant in the form of upside versus the form of downside. So as an example here, noting the histogram, the MACD levels in here before this breakout, you had a huge move with a wonderful candle on this chart, and it coincided with lower levels relative to what the MACD was telling us. This was a bit of a signal for some traders, right? That, hey, maybe this move is a good one, but it might be a while before we get the opportunity to sell there again. Let's take some money off and pat ourselves on the back for a good trade. And one of the reminders about technical analysis is a lot of so-called self-fulfillment, because so many investors and traders rely on technical analysis to some extent these days, that it might be it's really easy to look back in hindsight and see these things. But the more you pay attention to these items, the more you watch the market on a consistent basis, and you see things like this develop, and you think about the possibility of them developing before they happen, the longer and more you work at this, the more you will see these instances play out. And that's what's going to give you the confidence to start positioning based on some of those indicators. It's going to take time. The ongoing process is always there, meaning you are learning 100% of the time. I know I am constantly, never ceasing to learn, but commonly relying on my trade management to keep me in the game along the way. So not an easy process, I will mention, but I hope it's fun. And if you're not having fun, then let me just say, hey, maybe there's an opportunity to step back, because even though the difficult market can be difficult for us, I think of trading as a fun experience, and I hope that you do as well. But if you're not, then something needs to change. So maybe that's something for a conversation with us. We want to help out. We want to make sure you're enjoying it. Don't feel like you need to be trading or doing a lot of work necessarily. If you're not having any fun, that's not the point of this, as far as I'm concerned. So, all right, let's see. Next up, let's go ahead and talk about the existing situation in the market. So we're going to bring over Think or Swim. I'm going to continue the conversation of trend analysis. Let's bring in the S&P 500. I've got some lines drawn in. I'm going to back this stuff out. I don't think I'm going to be sharing a lot of stuff that some of you haven't already been considering as it relates to the S&P 500 here. But let's go back to a weekly look and just talk about what we're seeing in the long range trend here. I'm going to go to a 5-year chart. I've got a linear regression line, which really just kind of highlights the line of best fit for the price action over the window of time we're looking at. And it looks like I'm going to need to go a little deeper. So we're going to go to 10 years so that we can find our COVID bottom, which is where we are right back here, right around 2,200. And if we were just evaluating the overall trend, everybody, we could still say that we've got pretty clear higher lows along the way. Each of these lows higher than the last, right? And our higher highs all along the way. Now, that's in the long run, right? In the last 6 years, that's what we have seen. However, outside of that 5 years, and we looked at just this year or the last 12 months even, well, then things are a lot different, right? We have a 12-month chart dating back to April 24 of last year, and you can see where we reside. Now, there was a period of an uptrend in place, right? So we had higher highs, higher lows, more higher lows, even into here, higher lows. Even this one is still higher than the last, even though this could be considered just a bit of a breather, right? I think a lot of traders looked at this and said, well, they didn't like the setup in here necessarily, and yet price action took us through, carried us, and nonetheless, whether you think the market's ready to break down or you think it's ready to break out, the approach that makes the most sense for many investors and traders is to kind of let things develop and give you some semblance of confirmation. That's not something we discuss in the deck, but I do think it makes a whole lot of sense for us as investors and traders. And ultimately, it's just having some basic points of interest, some detail that you as an investor, you as a trader will use to say, this has occurred. This gives me the confidence to believe that the market is doing what I want it to do. Therefore, I can deploy new funds. Or the market is uncertain. I am less confident, less comfortable. I'm going to build cash through the use of selling stock, reducing the sizes of my individualized positions, and just being a little bit more defensive in nature. And for some of you, that might not be comfort in the form of cash. Some of you might say, yeah, as much as I like the idea of building cash, maybe what I'm going to do is take a little bit of that cash and I'll buy some alternative investments. In times of uncertainty, some investors do see interest in increasing in gold or precious metals, gold and silver both potentially as examples. Now, commonly they're thought of from an allocation standpoint as very small percentages of assets devoted to a large long-term portfolio. And I'm going to say small, we're talking less than 5% allocation. So not to be considered huge, but if you're investing for the overall long window of time that could be 10, 15, 20 years or more, well, then it makes perfect sense to be allocated to a model against which you can base your decisions. And of course, last week we talked about that modeling a little bit. We discussed the portfolio checkup tool, defining the model for ourselves, going through the Schwab profile questionnaire, either relying on the approximation of returns based on a 30-plus year window of market history, or answering a series of questions that will enable the platform to kind of lead you towards a level of aggression with market investment that you should have comfort with. And yet, I always got to say it. We have the link here. If you want to go back and watch that class, I'd certainly invite you to do so. I was just utilizing the portfolio checkup tool today for my own approach in my long-term portfolio. And I really invite you to check it out, use it, and define your model. But inevitably, whatever level of comfort you think you have for risk, undergoing market swings like the one we've been in right now is a really good way to learn if the level of risk that you have defined for yourself is truly valid. Most commonly, we will not be comfortable with the level we audibly state. Yeah, I'm comfortable being allocated to an aggressive model portfolio until suddenly I'm 35 to 39, 40% down from the peak, which is entirely within reason with an aggressive model that's developed in large cap stock, heavy in large cap stock. You're going to get those things to occur from time to time. Market cycles will do that. And further, it's noted that the market will definitely move lower than we have comfort for, lower than areas that we think it should. Now, today in particular, when we're talking about the trend that we've been seeing, a lot of investors very excited about what we've gotten in the last 3-4 days here. They're pleased with the fact that we are so far well off of our lows now, right? Let's draw a line from those lows and let's see. At our current price, we are up about 13%. Nothing like price action to change sentiment in the market, is there, right? Just think about how you felt this time last week. We were in the midst of pulling back, right? 1, 2, 3, 4. We were sitting right about here. Little different, right? We'd been rejected up at this zone, made a lower high, did not stick, got pushed back lower, didn't feel as good. Now, we did deploy some funds, but inevitably, it is the upward movement, green candles, new price levels achieved, and suddenly everybody's feeling really good about things, right? But there's always underlying detail that we need to pay attention to. And in this case, in the market, we've got headline risk about which to pay attention and be worried. So we can't just entirely get too confident, too comfortable. If you are that individual who says, hey, I believe that we have seen the worst of what we're going to see, that's fine. Where we start projecting is where we might get ourselves in a little bit of trouble. So inevitably, if you're feeling as though you might be on the right side of things and the market is going back to the uptrend that we've been witnessing with that weekly chart, and we're just going to continue along the green line higher, well, then what we have done in the last few weeks would be giving us opportunity to be buyers, right? And if you were looking to enter at a moment where you were feeling a little bit more confident, the action of the last 2 days could be sufficient because we have recaptured for 2 days the 20-day moving average. We have not been above the 20-day since back here. I'll point out we closed above it for 2 days, and then day 3, I think we closed below it. The close here was 57.12, and the 20-day moving average on that day was 57.14. So we did close below it by about 2 points. So technically, we only got 2 closes above the 20-day. Today is very likely looking like our second consecutive close above the 20-day. Some traders would say that's enough. Some investors would say that's enough. We think the new trend is in place. They'd feel comfortable putting a little bit of money to work. Now, if you're an investor, the investors might say, cool, I like it, but I've been sitting on cash for a bit. Let's not go whole hog into our trade or investments here. Let's deploy 10%, 20%, half, whatever it is that the investor has set for themselves. Hey, when markets shift, this is how I'm going to approach it. That's what I want to see you referring to, okay? So if that is in your process, that's what you're looking for, that some traders will do something like that today. Some might look for a third consecutive close. And some might just say, yeah, not until we're above maybe a longer range moving average, like that 50-day up here, which is still a ways away. Okay. And none of this is, of course, to suggest that I know that the bottom is in. I don't. I still look at that 48.35. I feel like that presents as an area we could need a retest of. I would not be surprised by that. And the truth of the matter is, yes, we have traded once more to this same level, but we're not seeing any action above it just yet, are we? And maybe it's just a situation where we need another day, right? Maybe we just need tomorrow. So if this red line, as I suspect it's currently drawn as, it is resistance for us, right? That is the ceiling overhead. And maybe we have banged our heads on that ceiling once or came shy of it a couple of times, and then today we've gotten up there. Maybe now is the chance for us to, springboard up through resistance, pushing through the drywall, creating a former ceiling, now a floor. And if that were to happen, a lot of bulls are going to start feeling a little bit more confident, aren't they? Because we will have then moved potentially through a ceiling and that we can now define as a solid floor for us. So I think it makes a lot of sense for many investors who are sitting on their hands and timid. You can take one of two approaches. You can say you don't have enough confirmation and you're going to be patient and wait for confirmation, very disciplined approach. You could also say, I don't want to miss on potential for that, and I'll put a little bit to work here. Just understand who you are and further understand which of those scenarios you're going to be able to deal with more. Not putting any money to work, watching a gap move higher and not having the enough exposure if it goes, or putting that money to work today and us not moving through the red line and going lower from here instead. Either one of those scenarios can happen, right? We just don't know. The risk is there on both sides of things. Okay. So that's a short-term look at things on the S&P 500, at least. The truth is that we've seen a lot of similarities in the S&P and the NASDAQ 100, both of them over the 20-day moving averages now, and both of them having run to a potential zone of resistance. It happens to look very similar, doesn't it? And yeah, Josh, hey, no arguments here, Josh. I would probably lean towards that concept in a different class, that's for sure. But when we're talking getting started, I can't very well bring options into the mix. But I'm totally with you, and I understand where you're coming from, because what you're talking about is simply incorporating your opportunities with a lot less cash deployed to take advantage of those opportunities. I like this from a generic standpoint, I should say. But nonetheless, if we're keeping it simple, you're seeing the same thing in the NASDAQ here, right? Potential resistance, potential ceiling right overhead. We've hit our heads on it a couple of times. Maybe we've worn down the sheetrock enough to pop through on the next one. But ultimately, traders who are disciplined are waiting for a close over the red line for that validation, that confirmation that's going to make them feel a lot better. And again, some of you may not want to wait. Some of you would feel fine putting money to work, but know that if a reversal were to occur, know how you want to act then. Always give yourself an understanding of what will I do if I'm wrong. And I know that's hard, but if you lead from the standpoint of what if I'm wrong, you're going to find yourself investing fewer of your dollars. And when things go awry, that means you're going to be exposing less of your capital to risk. And that should benefit you over the long haul nonetheless, just by being a little bit more disciplined, deploying fewer dollars. We as humans, we've got a lot of roadblocks in our head. And it's our job to recognize and then overcome those roadblocks. For a lot of traders and investors alike, recognition of said roadblock is the first step to improvement in trade opportunities and trading overall. So keep that in mind as well. Okay, what do you say we take a look at our current example portfolio here? Last week, we got to work deploying some money in some key areas. We invested a few dollars into some healthcare stocks, some dollars into financials, some dollars into technology. Now, I want to mention that when we did this, and again, this is in that same link that Scott has shared with us in the chat, we talked about this and the reasoning behind it. The reason we put money to work last week was just the opportunity to take advantage of the pullback we have seen. We wanted to deploy a portion of our money. We did put to work a little bit more than 25%. Now, today, we're going to look to do something similar, but in some differing groups, right? We've got healthcare, we've got financials, and we've got technology. But now, I wanted to build a portion of the portfolio. It's going to be heavy in utilities, heavy in real estate. And again, I'm not going to concern myself with necessarily underlying fundamental criteria, meaning I'm not evaluating companies for fundamental balance sheet health. Okay. Ultimately, what we are trying to do, though, is get some money into some groups in the portfolio that we don't currently have exposure to. And we are going to do that in groups that are going to provide some income to the portfolio in the form of dividends, commonly utilities or real estate investment trusts, or additionally could be something like telecommunications in the communication space, something like AT&T, Verizon, etc. I also want to just point out the timing of our entrance last week wasn't perfect. So again, when we go back to that chart on the S&P, so a week ago was the 17th, right? And so we were in this move here. And this was the day that we deployed and bought all those individual equities. And even though the stocks went down a day later, here we are 4 days later, we're up, right? And all I want to point out here is that if our approach is one of long-term fundamentals and long-term putting money to work at depressed levels consistently, well, then nothing we did last week was terrific because we don't know what the bottom is. It just happens to be green at this moment in time. It doesn't mean anything more than that, okay? Don't be blinded by the fact that all of those positions are green simply because the majority of them weren't necessarily green prior to today. There's been some good moves. It's been fantastic, wonderful, we'll take it, but that doesn't mean anything, okay? When we're deploying money for 10 years, 15 years, 20 years, no issues. The bottom line is get that money invested. Let it work for you for a longer period of time. Don't concern yourself with short-term movements like the ones we're seeing here in these underlying stocks. Okay, so let's take a gander, if you will. We're going to move over to our Market Watch tab and go to our quotes. And we are going to dive in to some industry groups. We're going to look at utilities. So I'll say, yeah, show me all utilities here. And I'm going to sort utilities. Now, you know what? I'm going to find this better to do in the scanner tool. Because one of the notes I have here for you, everybody, when you're working with watch lists, you're going to find that there might be individual equities that are no longer active, and they could be in that list, and it could take some time to load the list properly, and you might wait. I don't want you to be sitting around waiting. So one of the cheats I like to do is to move into the just a standard scan. So let's eliminate all this. We'll just reset my scan criteria. And I'm just saying we're going to look within the S&P 500. Okay, so I'll go to the public S&P 500. I'm going to intersect with utilities. And I just want to make sure that I'm looking at stock whose last trade is at least $10 a share. Very basic, right? There's only 31 matches. So let's, before we scan, let's just make sure I've got my criteria in here that I want. I don't care about the last trade. I don't care about the percent. Really, the percent change is fine, but let's look at this on a year-to-date change, percentage change year-to-date. And then I've also got some relative strength details, I think. Let's see. Oh, I guess I don't have them in here. I thought it was going to show. Oh, there they are. Sorry, everybody. I got a 21-day relative strength and 89-day relative strength. And then one more, our 52-week high and low, but more specifically, the percentage difference from the 52-week high and 52-week low. And this is just going to give you a little bit better understanding of where the stock might reside in its current trend. So we'll hit scan on utilities here. And, oh, I forgot one thing we're going to need if we're looking at utilities here. One thing we can do is add in, how about dividend yield? So let's incorporate yields here. So this will give us another reason to monitor. So this could work to find us some utility exposure. And if we sorted it based on yield, and then looked for, some outperformance based on the last few weeks or maybe the last few months. The one that pops up here that just kind of jumps off the screen at me with the higher yield is this First Energy, FE. So let's just take a look at FE. It looks like the rate is 4.2%. It is within 6% of its 52-week high, and it's been one of the leaders in utilities since for the last 3 weeks and the last 4 months. In fact, let's do this real quick. Let's go ahead and sort by that 89-day relative strength. And I guess maybe over that window of time, not as excitable, huh? So here it is way down the list. So let's take a look at FE, and maybe we're going to come back and check out Exelon here in a moment. So I'll hit that 5, which then populates this in my chart right off. Okay, well, we've seen maybe something intriguing as it relates to First Energy here, everybody. The reason that this might be intriguing for some of you is you could see that there's been a bit of a change in trend of late, right? We definitely have a very short-term shift as the rate situation has kind of gotten squirrely, right? So no shock there. But from a trend standpoint, some of you might point out that we have broken a downtrend line, depending on how you choose to draw it in here. We may have broken a couple of different lines here. Now, we will make note of the fact that, we had this earnings, right? And this earnings back in February was not well received, and the stock got pounded thereafter. But that was really providing one heck of a buying opportunity. Look at how the floor or support acted down here, everybody. I mean, lots of indications that that traders who were buying this up were working really, really diligently here to get shares in First Energy at this $38 level. They really wanted to see this, right? So let's go ahead and let's zoom into this just to highlight, when we talk about trend analysis and defining support, defining resistance, it's hard in the moment. I've stated it's not necessarily easy if it's something you've not been paying attention to in the past. But if you had drawn a line at the lows that we had seen previously and just said, go ahead and extend that line, let's see if we can validate some support there. And then you get to the time when we start trading at that level. What are we seeing here? Look at all these tails. There's a tail here, another one here, and then you've got 2 more over here, right? I'll extend this like so. So all of the time that the prices get down into 38 and below, it has been the instance where traders said, no, we're not going to let that fly. We're going to be a buyer there. I'm only bringing this up not to define it from a First Energy standpoint, but really just a standpoint of understanding why a trader or investor will look at an area that they deem to be support and try not to act intraday, right? Imagine this candle didn't look so good right here when we were trading at 37.58 this day. This would have been red, okay? It would have been ugly. If you looked at it midday and it was red, you may have been saying things like, forget this market, I'm moving on, or I couldn't possibly be buying First Energy down here. But if you bought First Energy 3 points ago, well, then you're pleased because the dividend yield that's available today at 4.19% would have been a bit higher at $38 entry, right? So, that's one of the considerations some investors who are scouring and looking for yield might be looking for, right? And if you're prepared and you're out there watching, keeping an eye on your watch list and whatnot, well, then this can become an opportunity where the trader would start to expose a little bit of money. In our case, we're looking for yield, which we can't capture or improve from here, but we are of the belief we've broken a recent downtrend with price action. The recent earnings report that came out yesterday was received favorably. So we'll take that as breakout and favorable moving forward. We'll get a little utilities exposure through investment here. So let's go ahead and add 100 shares here. And that's not a whole lot of a validation or review of a fundamental process, everybody. So just keep in mind, this is an example and not a recommendation in any way. We are buying it to incorporate utilities into our example portfolio and those that pay a dividend. So we're going to go ahead and, I'm going to change that to a market. And there we go. Now have 100 shares of First Energy, which of course gets dropped into a utilities bucket. Now it should be utilities. That disappoints me. That should have been in utilities. All right. So it's in others. Okay. Now, another alternative way that you can go about this, instead of defining your scan the way that we did originally here, right? We went into scan, said S&P 500 stocks in utilities. Yes, we could go to the same thing and do real estate from here, for example. But if you're less concerned about the sector in which you're exposing this money, maybe you're more concerned with just looking at a series of charts. And our friend Mike Fairborn went through this recently. In fact, again, on that link that Scott has shared with the archive of this class, Mike did a few weeks ago, I think when I was out in Detroit, did a whole conversation around the dividend aristocrats and dividend kings. And they can be found via the scan functions, right? The quote details here in our public watch lists. So come here into the public, and what we can look for are 25-year dividend and 50-year dividend payers. So if, for example, that is how you want to look at this, a couple of things for your consideration. Number one, go ahead and incorporate the description or the sector of the company here. You want to have a clear understanding, even though you might be leading with a desire to find a stock that fits your process rather than maybe being entirely tied, to a sector relationship. It can still be instructive and helpful to have it in your drop-down menu there, okay? Because remember, every one of our headers is sortable, so it'd be really easy to go ahead and work through it like so, right? So we could sort and see, all right, I've got, I'm on, maybe I do want something in this space or, what have you. You can always sort by that. I like the idea of also incorporating dividend yield. Okay, let's put that higher here. Go. And then, of course, sort by dividend yield from these dividend. I always get this wrong. I think 25-year dividends, 25 years of paying the dividend and raising the dividend, those are our aristocrats, and the dividend kings, the 50-year list. Listen, it's super impressive to continually pay a dividend. It's even more impressive to continually raise said dividend. So that's why these lists are available. As you can see, there's some pretty strong yields in here. Many of these are going to fall right in your wheelhouse between 3 and 4%, which is kind of the wheelhouse, if you will, of a dividend paying strategist, something they might look for. Let's just throw Ben Franklin in here just for the heck of it. Let's see how that looks on a chart. Yeah, see, I mean, it's not in an uptrend, right? It's pretty clearly in a downtrend, having a struggle of things, but a dip. That's why the yield is where it's at right now. Doesn't mean it's going to be the absolute best time to get into this position. We are at resistance, but a breakthrough here could be a nice short-term development, a pullback from there, a possible nice short-term development for those of you wanting to improve that yield. Now, one final note about yield, everybody. If you're the individual scouring the market, looking for yield, building dividends, etc., that's perfectly fine. But if you bought a stock for the purpose of the yield, you better pay attention to whether that's continuing to be paid. If they change the price or they decrease the dividend, cut the dividend entirely, decide no longer to pay it, etc., those are shifts you need to be aware of. Okay? All right. Covered quite a bit today, everybody. I want to thank you all for being here. It was very active in the chat. I did notice we got a survey opportunity, so please take a minute and let us know your thoughts on things. Sorry, Eva, I know it's, the black background is not ideal for 100% of us. The truth of the matter is neither are the lighter backgrounds, and the black is what works best for my eyes, and I apologize. I know that's difficult, but all that stated, I still want to hear from you, everybody. So if you don't mind, take that 60 to 90 seconds, give us a score on how we did today, but also let me know what else you'd like to see from this class in particular, the getting started with stock investing process. Hopefully we've learned some new items today. We definitely placed a brand new transaction, another one for us to check out next week when we reconvene. Same bat time, same bat channel. So thanks for being here. Thank you to Scott Thompson there in the chat. You can follow us on X. Hit that thumbs up button down below for us and make sure you're subscribed to the Schwab YouTube coaching channel, everybody. I look forward to seeing you all again real soon.